Starting.
Okay, we're starting.
Okay,
Okay,
it's
go ahead.
5:30.
Yeah.
Hello, this is Joanne Obata with the International Model Stock Investment Club. Welcome. The International Model Stock Investment Club is a better investing model club open to the public. Our meetings are held on the third Monday of each month at this time, the exception being December this month when we meet on the second Monday of the month. All of our meetings and stock studies are held online, allowing us to have members from around the world. Our current members are from the United States, Canada, and China. Guests, as observers, you will be muted during the meeting and will have an opportunity for questions and comments once the meeting ends. Any companies mentioned today are for educational purposes only and are not intended to be a recommendation for buying or selling any stocks. We ask that you conduct your own review and analysis of any company of interest before making an investment decision. This meeting may mention products or services not endorsed by BetterInvesting or the club. The views expressed are those of members and do not necessarily represent those of BetterInvesting. This meeting is also being recorded and will be posted to our YouTube channel for future use. Let's see, I'm going to turn it over to, let me just do a quick review of our agenda. So we will have, Jay will be doing an introduction of our guest club mentor. Tom will be doing our treasurer's report. Then we will go into our PERT and annual reports, and followed by a discussion of whether or not we'll buy or sell any of the stocks reviewed. And then we will go over business items. Now I will turn the discussion over to Jay to introduce our guest.
Sure. Thank you, Joanne. So our club continuously looking for ways to improve, and we thought about to invite various BI members with comprehensive understanding of better investing methodologies and principles to mentor our club for a short period of time to give us a feedback and coaching us, how to improve our stock studies, how we do our quarterly reports and annual reports. So tonight we are having our first club mentor, our guest, and Suzanne Koster, who is a director of Online Chapter, and she actually is New York based. She has her own club. And so we are very pleased to have Suzanne, and she will chime in as needed to give us feedback on how things we could have improved on, do things differently, or maybe give us some examples that how her club did well to share her experience with us. So thank you, Suzanne, for attending our meeting tonight.
You're quite welcome. I'm privileged to be here, and I'd love to listen in.
Okay, great. Thank you. So next is a treasury report. So I will make Tom as a presenter. Tom Jones. Okay.
Okay, can everybody see?
Yep.
Hello. Okay. So this is the treasurer's report. So this is the portfolio by the Manifest Investing Quality Rating. It's ranked top to bottom. So most all of the stocks are in their favorable range. A few of them down here at the bottom are not, but the the total portfolio has a decent rating, and I'll go into how this rating is calculated later on in my presentation. This is the portfolio evaluation as of Friday, and thanks. I copied a little bit from the November report from last month, and I was just some of this. I highlighted the stocks that I thought had significant gains. I mean, like some of them have really had significant price changes in the past month, and all to the positive. Well, I guess Kirkland is down, but the others had some pretty big gains. So I wanted to point out, I guess, maybe that's the wrong date, but anyway, on Friday, Disney was up 14% on positive news that they talked about at their investor day regarding their Disney Plus service. And I guess also the vaccine coming for the pandemic was certainly probably helping the company also. Here's the I'll just go over the portfolio here, how the prices have changed over the past year. For the past week, Disney and Innovative Properties are doing the best. Over the past month, Disney, Air Lease, and Inogen. Inogen's down for the year, but Air Lease has also benefited from the vaccine, I think. Everybody's hopeful that we'll get through this quickly, but it's going to take a while, I think. In the last 3 months, Lamb certainly has outperformed. And then if we look at the last 12 months, Innovative Properties is the clear winner. And Manifest recommends considering selling companies that are underperforming the relative performance or underperforming the market by 20%. So the stocks that we have down in this red box are all, the S&P was up about 18.8 or 8% over the past 12 months. And the stocks down here in the box are all 20% or more below the market over the past year. And here's how the sectors have performed. And there's been what the analysts call a rotation. Some sectors of the market are doing better now, and some are doing worse than they were. So over the past year, energy has been the worst performing sector, but over the last month, they've been the best performing sector, which is quite a turnaround. They're still not back to even, but been quite a change. Technology is up the biggest, but it was only up. It was up 2% over the past 2.5% over the past month, but 43% over the past year. So and then over the past 3 months, energy has outperformed. And then here is over the past 12 months, the sector performance, and then here's the percentage of club assets that are in each of these sectors. So we have, I guess, the biggest weighting in communications with Facebook, Disney, and Comcast, and then the next is technology sector. And here are the sectors by Morningstar fair value, which they calculate fair value using the discount cash flow model. So if the stock is priced the same as their fair value, that would be 1. So stocks less than 1, they think, are they're selling for lower than fair value, and stocks over 1 are selling for a little bit more than fair value. So this is their take on the sectors. The Domino's has outperformed its sector and the index. Schwab has outperformed the sector, but not the index. IPR has just really been the star here this year. And Inogen has way underperformed on a 12-month basis. And here's a chart of Inogen over the past 6 months. So it has really, the last month or so, it has really gone up. But if you look at a 5-year chart, this kind of surprised me. The stock has made like a round trip, from the 30s and 40s up to looks like $280, and then back down again over the past 5 years. So if you're a long-term shareholder, that's quite a ride. So the communication sector, Facebook has outperformed. Comcast and Disney are less than the sector the sector ETF. Here's the companies in the sector ETF, at least the large percentages. And it's interesting to me that Comcast has outperformed Disney over the past 12 months, but Disney's done better recently. Air Lease has underperformed the sectors, but it's improved recently. It used to be way down. Lam has outperformed the technology sector, but Qualys, CyberArk, and FleetCor have underperformed. Over the past year, Franco-Nevada has outperformed the material sector and the price of gold, but over the past 3 months, both it and Kirkland have underperformed gold and the material sector. So Manifest recommends considering selling stocks that are, with less potential gain than the average, what they call my par, which is Manifest Investing par, I guess projected annual return or something like that. So anyway, these down here in the box are the ones that are less than that 6.3% figure. And so here's the portfolio by Morningstar fair value. So they think that Air Lease, Inogen, and Facebook are a little bit undervalued, and then these down here, Qualys, FleetCor, Lam, and Disney are possibly a little overvalued. Here's the portfolio by size diversification. We got 9.1% small and micro, 19.4 mid-size, 10.8 large, and 21.4 mega, and we're holding 33% cash. And so here's the allocations for the no allocations. I mean the diversification by industry and sector, and I put those the industry numbers were on that earlier slide. I think if you've all seen this probably before, we haven't made much changes to the portfolio. Let me see if I can get to my next segment here. So now I'm going to, let's see if I can get to slideshow, current slide. I'm going to go through a Manifest Investing a little bit here. I was trying to figure out, the potential of using it to, just take a second look at the portfolio, also to kind of explore their methodology, how they come up with their figures. So I made most of these slides on November 25th. And at that time, the Franco-Nevada was 130.48. It's 129.90 at the close today. So the price hasn't really changed in the last 3 weeks. They are projecting the return of 10.6%, including dividends, sales growth forecast of 11.7%. And here's the little chart that they give, which shows the projected return is the red line, the quality is the blue line, the green bars are the price, and the shaded pink area here is the relative return. That's relative to the market. So in these times when it's above the zero, they're projecting the stock will do better than the market. And down here in this area, when it's below zero, the stock is projected to return less than the market. Now they used to get most of their data, it seems, from Value Line. And so this is the areas that in this box here is data is contained. This is another box. And then I'll also be addressing the some of the footnotes here in Value Line. So here, this was interesting to me, you know, like how in the world did the projected return go from 2.7% in July to 10.6 in October? Now, to me, that's a significant change. So I dug up the two value lines, and I've never done this before. Before I did this exercise, comparing one edition of value line to the next, and value line really changed their mind over this time period. You know, they got much more optimistic in October. So here you can see like the sales, cash flow, earnings. You know, sales went from 7.5 to 10. Cash flow went from 8.5 to 11.5. Earnings went from 14 to 17. So this is, to me, significant changes. And then a lot of these numbers changed. I wanted to highlight profit margin. They think the profit margin's going up 5%, which I guess would make sense when the price of gold is up, since this is a gold company. And so, you know, I just, you know, this, I don't have it. This is kind of my supposition that, you know, in order to generate these reports, this value line needs to close their books, you know, maybe a couple weeks before they put these reports out. So I'm thinking in order to, you know, finalize everything and publish it. So I'm thinking that, you know, the October report was generated mid-September. The July report was generated mid-June. So in mid-June, the price of gold was probably $1,750. And in mid-September, the price of gold was like $1,950 or $1,975. So that's my guess as to why the it's come back down maybe close to $100, but per ounce. But to me, that's possibly why they changed their projections. So anyway, Manifest is projecting sales growth of 11.5, which compares to this 10% sales growth. They say they use Value Line plus some other data sources. And then using the net profit margin of 52.8%, which comes straight from Value Line. And then I calculated, tried to, you know, calculate how they got their earnings per share figure. So they took, you know, the current sales, which is 973.8 million, and grow it at 11.7% per year for 5 years. And the end result is about 1.7 billion. And to multiply that figure times the net profit margin, and you get the net profit of 894 million. Divide that by 200 million shares, and they came up with $4.47, which pretty well matches their 448 figure. But, you know, Value Line is projecting, you know, even though they have these optimistic growth figures, they have $3.50 in that column, which just kind of boggles my mind. And also the sales figure that, you know, using the projections we have here for Manifest, we come up, you know, 1.7 billion. They've got 1.3 billion. So, you know, I don't know. Sometimes I'm puzzled by that. So anyway, then we're figuring out the price appreciation. So I take the earnings times the 46 PE that they're assuming, and we get the price of $206, and then, you know, calculate the return on that over 5 years from the current price. I came out to rounds to 9.6%, which is the same as Manifest there. So I was able to it seems like I duplicated their results. So this is probably a very confusing slide, but I thought it was interesting to compare Value Line versus Morningstar data. Now, Value Line adjusts the data. here according to their footnotes. It says earnings per share footnote A, which they excluded non-recurring items. So it looks to me like they added some non-recurring items back into the reported or the GAAP earnings, which Morningstar reports, which is what we use from our data source through Better Investing, and get their results. So you look at 2015, Morningstar, the GAAP earnings are 16 cents per share, but Value Line's reporting 48 cents. But if we look here at the footnote, it looks like they added 32 cents back in. So they essentially tripled the earnings with their for that year with their accounting. And then I looked at the earnings for this year from the company. This is Morningstar. I snipped this out of Morningstar. So they've only made essentially 81 cents so far this year, because they had a loss of 52 cents the first quarter. And the first quarter report showed that they wrote down some assets, oil assets that they earn. They're mostly a gold company, but they also have some energy assets, maybe like 10% of the company. Like in the Permian Basin in Texas, they wrote some of the investments down, so that's why they're declaring that loss. So that's, really like an accounting loss, but that's still what you have to report for accounting purposes. And so, so there's that. And then also I decided to calculate these figures here. So this is Value Line saying that, they're estimating from 2017, 2019 to 23 to 25. These are their results. So I just went with the mid years. I went with 2018 to 2024. So I figured, go from this figure here to 2018 and considered that this is 2024. And so I go to those figures in the they're a little bit higher than what Value Line has here. So, I don't know, they're in the ballpark, but this is, how those numbers calculate with a financial calculator. But then I started looking at this 2021 and this 2023 to 25, those numbers are awfully close. So I did the calculation from 21 to 24, splitting the difference here in the years, and they're these, the sales are like, 1%, 2%, or 3%. So I don't know. It looks like they're from these numbers here. They don't have a huge explanation, but their Value Line's thinking that the sales and earnings growth is really going to slow down in the near future over this time period. But then if you just look at this box here, you think, blue skies, but you look at these numbers here and that's probably, we probably wouldn't want to invest in a company that's growing at that rate. So anyway, this is the definition of non-recurring items. It's items that, write down litigation charges, things that aren't or mergers, acquisitions. And then this is Value Line's definition of cash flow. Some of the net income plus non-cash charges, which is different from free cash flow. And this is how Manifest calculates these financial, their quality rating. Financial strength is the composite grade based on Morningstar, Standard & Poor's, Value Line, plus current interest rates. Compare it to the other companies and rank them by percentile. EPS stability is like a mathematical score reflecting the straightness of the line. It can also be called R squared. Sales growth forecast is compared to industry growth. So, compare it, to the companies in its own industry. Net profit margin is the same way. And then the quality penalty, which they got five points there. And this, all the footnote says is companies with less than 10 years of history are penalized by 5 points per year. So I guess they're assuming this company only has 9 years of history, which I don't know, seems a little silly to me, but that's the way they do it. And so anyway, the calculated quality rating is compared to all the other companies and then ranked by percentile. So they get a score of 74, and that 74 puts them in the 94th percentile, which as far as this quality rating score, they're in the top 6% of companies. That's what that 94th percentile means. So here is, well, just this this is probably a little bit easier to explain. So anyway, here's the I wanted to compare this to Facebook, because Facebook, according to Manifest, you can see this relative return. You know, it's above zero for, you know, the last 4 or 5 years. Franco, Nevada, I guess they haven't been covering it that long. You know, it's above and below the line. So it's, you know, just compared to, you know, really successful company, they haven't done, well, I guess kind of mediocre, I guess.
They're mining.
So here's the portfolio, again ranked by the par value. And so I did a couple projections here to see what would happen if we made some changes. So let's say this is just theoretical, like the projected return is 6.9%. If we invest $20,000 of our cash in the Standard & Poor's 500 ETF, which has a which would, you know, just a market rate, they're projecting it of 9.5%. That would raise our return of the portfolio potential return to 9.2%. You know, investing the cash in something with a better yield than the 1.3% that they're assuming here, which I think is probably a little high for cash these days. And then this one, I shot the moon, so selling the Disney and Algonquin and buying $30,000 worth of Google, which they say has a fairly high projected return, and that brings the portfolio up to 12.5%. So those are things we could do to I mean, investing the cash and selling the lower performing stocks would increase the portfolio potential return for the portfolio, at least by this methodology. And so next month in January, Mike Torbenson is going to be presenting his portfolio review, which focuses on PERT. And Tom Laughlin and I are going to assist in getting ready for this. And so I would like to request that everybody move a copy of the current SSG for your companies to this folder here, current SSGs for the club, which I created inside the portfolio management folder. And it's at this link. I will send out this link plus these two presentations so that, well, I mean, I will put them in the treasurer's, I'll put the treasurer's report in the treasurer's report folder, and also this portfolio, this manifest thing in the portfolio management folder. And I'll send links to those to make it easier to get to them. So does anybody have any questions?
Tom,
Thank you,
do you want,
Tom.
yeah,
We
do
have
you
1
want,
minute. We have 1 minute.
do you want to quickly introduce Mike Turberson? Who's he and how you get invited
Well,
him?
he's, I guess, a longtime BI member and educator, and he has, I know Tom Loftus has sent out some links to his presentations that he has given, and he has some pretty detailed presentations where he uses the PERT chart to I guess have people review and improve their portfolios. It's based on you know, what everybody's judgment is on the SSGs that are presented.
Mm-hmm. That's great. Yeah, I attended his class before, so I'm so glad that he's willing and able to give us a education topic on portfolio review.
Yeah, that's great.
Awesome.
Thank you,
Yeah.
Tom. Let's move on to our quarterly and annual reports.
You're welcome.
We have, yes, thank you. It's very comprehensive, Tom. Great job. Okay, next we're going to do I guess I have Tom Loftus for Air Lease. Did you want to review the sell checklist, Tom Loftus?
Okay, I think it's at
Or is it?
it's a hold, so I don't think I
Oh, it's
need
a
to
hold.
do.
Okay.
Okay.
All right. Let's change this to hold. Tom Jones, I know you went over Franco, Nevada. Are you still feeling like that's a
Well,
sell?
I didn't complete a copy of the sell checklist to present to the company or to the meeting. I went through it, and I was, I went into it with the idea that, hey, this is a sell. And it did not meet the criteria. The criteria all seemed to be like, are the fundamentals deteriorating for this company? And
So you consider it as a hold?
the fundamentals are not deteriorating. So I couldn't
Okay.
justify it by that, but also it looks like, as far as I know, nobody holds the stock. So
that wasn't okay. We'll come to that in our business items after this discussion to how we can remedy that. If nobody holds the stock, we're going to be tracking that.
But it would be a hold.
Okay.
Under the, if somebody owns it.
Okay. Is Matt here?
Yes.
Yeah, Matt's here. Matt,
I'm here.
Inogen, did you want to review the sell checklist for Inogen?
Sure, why not?
Okay. I'll give you the screen.
I don't know if I did it right. Did you give it to me?
That's okay. We'll go over it.
Yeah. So I just, hopefully you can see this. I'll make it a little bigger. Is that good?
Yep.
Perfect.
Oh, you know what? Sorry, I should have done it this way. There. That's good or bigger? Okay. So I just kind of went through the checklist, and then I put in bold each of the bullet points that I thought, it's satisfied for Inogen. So the first one was slowing or declining sales and or growth is a warning sign. Check the trailing 12 months growth rates in PERT or quarterly trend graph. And the sales have been in decline since mid 2019 and then accelerated recently due to COVID pandemic. So here's kind of what it looks like. You want me to zoom in on this too?
Yeah,
that's okay.
Good. Yeah.
So this is what it looks like. The sales just drop, or the earnings at least drop off a cliff, and then the sales start to decline as well. So looking at the quarterly data, you can see on a trailing 4 quarters basis, earnings are now negative 106.3% over the trailing 4 quarters, and sales are negative 15%. But it started pretty far back even before COVID, and then COVID kind of just seemed to accelerate the declines that were already happening. So I think it does check that box, if you will. Declining profit margins, 2A, 2B on the SSG. So pre-tax profit margins in decline since mid-2017, and it's negative 3 of the last 4 quarters. So if we look at our percent of sales, pre-tax profit, so we peaked back in 2018, and it was pretty consistent, at least for 3 years, 16, 17, and 18, around 10 to 12% or so. And then starting in early 2019, it starts to decline into the single digits, and it's just been a steady decline until recently it reached negative 1.4%. Last one, there's no increasing debt, no increasing inventories or receivables. They've actually been managing that. decreasing or negative cash flow. So the cash flow did decline year over year. I meant to put it on here, but I forgot. But it has declined, the cash flow. Then kind of going to the next category, any adverse company changes. So in June, the CEO that took over in 2017, so right back here when margins were pretty good, announced that he'll be leaving the company, which given the performance is probably not surprising. So he'll depart by the end of 2021, and they announced that they are for a new CEO. Lastly, the last one, products are no longer in demand. I put this on there because of COVID mainly, but products typically are sold to traveling seniors or people with breathing problems. And since most travel has stopped for a lot of seniors, their products are really not in demand. Kind of the big change for them recently, at least, and why they've been so impacted by COVID. Anyway, that is the main reasons on the sell checklist I recommended to sell. Any questions?
What were the items below that? 4, 5, 6?
So if the stock is overvalued, I guess, do we
So
have
did we,
one in every category, or is this just
yeah, go through every, because that's a comprehensive evaluation. So it's not just those top items, it's
Oh,
the rest of it. We should
yeah, I didn't meet
evaluate the
any of
rest
these
of
other ones though. So
it. Okay.
I wasn't under the impression it had to meet all of these because a stock that's declining would probably not
Overvalued.
valued, right?
Well, it could be, but I
Stock
mean,
is
if
doubled in
it's worth
price.
less than, go ahead.
The stock has doubled in price in the last month, last 3 weeks. I don't understand. I guess people are expecting that travel will pick up again. I don't know. It's an amazing product how it just takes oxygen from the air and converts it so it can be used. So you don't have to buy a tank of oxygen. It's kind of interesting product for old people who have breathing problems. And the sales I bought in at 20 and it's at 41. I can't understand why it keeps going up. And it's all you say is true, but it's kind of a mystery to me. Okay. And I did a stock selection guide. That came out. I used this what they call this preferred procedure, and maybe I did it wrong, but it came out a buy. And,
yeah, so I guess that's the weird thing is it comes out a buy, right?
Well, it's a mystery. Yes.
Yeah, and I think some of it is due to the really high price to earnings values that it's had. So you can see here, it's typically the high average PE has been like 120, and the low's been around 48. So in this, I used 83.7, and that in a buy range. But I guess I don't totally understand how a stock like this, I mean, there's just not that much growth to justify these types of price earnings multiples.
What projection did you use? The first
I
page.
used a 3%.
Oh, wow. You gave 5%
But
sales.
again, so the 3%,
Wow.
this is based on the annual. This is 3% it was in 2019, right? So the earnings, which are now negative, are going to have to bounce back to this point. Which, I mean, they might. I guess I'm not totally.
Why did you cross out 2018? Curious.
It seems to kind of be an abnormality. Oh, this was mainly due to the Tax Cut and Jobs Act.
Oh,
So this was a one-time benefit,
okay.
mainly from taxes.
Okay.
2018. Yeah. So you see here, their income tax rate was negative 72 and negative 45. But I mean, it is a good point. It's kind of at its low, so it could be like buying cheap, I guess. Although it's increased a lot lately, which everybody's pointed out. I personally just don't know that this is necessarily a good company to own. It might be a good value for sure. But if you kind of look, their earnings aside from 2018 have been pretty flat. So predicting any growth seems a little optimistic. You know, they've been about 97, 96, 94 cents per share for the last 4 years.
So Suzanne, case like this, we bought this company back in July. We only hold for what, July, 4 months, 5 months. 1 quarter. When we bought it, the company was already we know there was problem with supply chain, so it was already downgraded the picture like this. And we bought it, we thought it's undervalued, and then so this quarter continued decline like this. So what do you think? Should we hold a bit longer since we only hold for 2 quarters? What should we do? What would you recommend?
So I would recommend first reading the earnings transcript. The earnings were released in early November, and you can go on Seeking Alpha, and you don't even have to listen to the call. You can just read the transcript, and the company goes through in excruciating detail about what happened, why they didn't meet numbers or why they did, and where growth is going to come from or not. And they're very optimistic about what's going to happen now that patients can return to doctors' offices and the fact that Medicare is going to have a higher reimbursement rate. So I think you need to know, really, like, kick the tires. I can't just be about some numbers on a spreadsheet. I think you really need to have conviction in the stock and say, why did we buy it? And then why would we sell it if nothing has changed or only things got better? I mean, to me, when I look at this value line is a wonderful value line. I mean, you have earnings growing at 25%. You have all upside on the stock. And then if you read the earnings release from the company, I think that's really where you should start. You need to go back to something a little more fundamental. And if something really has changed since you bought the stock, finance, whatever it might be, then yes, maybe you'd sell it. But if you still have conviction in the stock and the price is lower, well, it's like on sale. So why wouldn't you double down and buy more?
I guess I'm saying we never bought it in the first place. That's more my perspective.
Well, were you the person that recommended the stock?
I am not.
No,
I would.
no. Yeah, we did a stock study together. We were looking for biotech, right, Piero? We had 4 companies. We did the research, and we come up with this one. Is a small. We were looking for small size company who has potential. This Inogen, we know there was issue, but the company at the time addressed that the supply chain problem was resolved. There's something to do with in USA, something that they couldn't provide the supply chain. And another company, actually also small company, it was performed better, but it's international company. We felt that it's going to be hard to track the financials. That's why we went for this one. Plus it's oxygen, and we thought, oh, because of COVID, and probably will have a higher demand to use the products. Piero, chime in if I misunderstood.
That's more or less what we thought. But for the company, when it's relatively good performance now is because the market is forward looking in nature, right? So people are anticipating that COVID is going to disappear and people are going to start traveling again. But I think it's a little premature. We still have to wait, hold on to it. It's sitting on about $200 million worth of cash. So it's not really, it has no debts, so it can weather the storm. It has good prospects.
Is this oxygen not really for traveling, but it's for leaving your home?
Yes.
Right. So you don't have to be traveling on an airplane or going on vacation. You could just be going to the supermarket, and that's when you'd want to have this portable oxygen. Right. I think that when you look at this, if you look at the last paragraph of the value line, that tells you everything. It says The 3 to 5 year projections are more promising. However, it doesn't have good price and earnings predictability. So there's going to be a lot of volatility in the stock. If you had conviction in the stock, when there is price volatility and you come to a meeting and you have the price has dropped, that's where you put your cash. That's when you buy more.
Yeah.
And then when it becomes overvalued in your portfolio, you trim a little bit as long as you still have conviction in the stock. So I don't see this as a bad choice. I just see, and I think getting rid of something because 3 months ago, that seems hasty to me. I don't make decisions like that unless like there's fraud, there's management change, the business is folding, something like that. It had to be extraordinary for me to get rid of something that I just bought 3 or 4 months ago.
Yeah.
So Matt, when you did anything, did you look the earnings, the earnings report from the what was it called? I forgot. Not value line. What do you call it? Suzanne just mentioned that you can earning a transcript.
Seeking Alpha.
Seeking Alpha. Did you
Yes.
catch anything good news, bad news? Would the management say anything about future?
Yeah, they expect people to start going back to doctor's offices and traveling again, which will cause more demand. They still have no forecast, and they wouldn't, commit to anything. So it's tough to say. I mean, they're not even giving a timeline, right? Because they don't know either, which is to be expected. But I think just for me as a fundamental investor, I mean, that's not impressive. Declining profit margins, declining earnings per share. I don't know.
Yeah. Well, the environment is terrible, right?
For the last
So
3 years.
that's to be expected.
Yeah, it's been a decline since before COVID, I guess. It's kind of the point.
Because of that production line problem. And Texas and California, where its production centers were located, had problems with that. And the two just kind of coincided. That was just COVID is a continuation of their production problems. That's it.
Why haven't they?
Like if we had thousands and thousands of dollars in it, I would trim it back. But we have a bit of money in it. We bought it cheap. Might as well just hold it.
Yeah, I would say hold a little bit longer.
Yeah, I would say hold it a little bit longer, but I'm a little concerned about the management change. If we would know what's going on, why that
Yeah, and I think
guy left.
tough to say that there's something like to do as well. So anyway, yeah, we can hold it. I just I think it's a fair point to bring up. Like it was a speculative buy.
Yeah.
Okay. Well, Matt, while we have you, can you do your Disney?
Yeah, let's do it. Disney. Okay, Disney annual reports. So I just updated this today. Starts late. I forgot I was due on this one. So it closed at 172 or so today. I kind of guessed at it. I wasn't sure if that's exactly what it was. We bought it at 92, 106, and 113. Just running through this. So 5-year average PE 18.6, average high 21, average low 15.6, and it's currently sitting at no price to earnings because they're losing money. Revenue for 2020 declined 23%. And for the quarter, and then declined 6.1% for the full year. Current assets actually increased from 28, I believe that's a billion with a B, to 35. Yeah, 30, it's millions. So yeah, 28 to 35 billion. Current liabilities declined, so the current ratio actually improved from 0.9 to 1.3. Free cash flow actually improved over last year as well, even despite all the issues. It was mainly lower in 2019 because they spent a significant amount of cash to buy 21st Century Fox. Continuing on down, historical sales growth rate. Oh, I think I forgot to update these. I apologize. But the historical, if we ignore the quarter and the trailing 4 quarters, 5.7 and 5.9, and then 3.5 and 11. Oh, these are the forecasts. I have 3.5 and 11.3% on the SSG. So earnings, excuse me, for the 10-year, because the earnings were so poor, they're at negative 30.5% over 10 years and negative 82.1 over 5. And then for the quarter and the trailing 4 quarters, negative 72.3 and negative 20.9. And again, my earnings on the SSG, I've got a 3% in there right now. Shares outstanding have actually increased. They've been issuing shares throughout the year from 1,666,000,000 shares to 1.8 billion shares. And lastly, evaluating management, pre-tax profit on sales for this past year, again, was terrible because mainly the park shut down, and negative 0.7% compared to their 5-year average of 18.8, and negative 3.3% return on equity for last fiscal year versus average 15.4. And then the debt to capital also increased very slightly this year over their average of 35.1. That being said, it was a dismal year for Disney. Get it? But the price, as Tom mentioned earlier, increased, I think it was like 15% or something like that on Friday. And that was mainly because of these announcements around their direct-to-consumer and streaming business. So we've been tracking these direct-to-consumer paid subscriber targets, and you have the actual versus their 2024 target. So Disney Plus, at the time of the earnings statement, they had 73.7 million subscribers. Their target at the beginning of the year was 60 to 90 million subscribers by 2024 for Disney Plus alone. And they basically hit that in late 2020. In their announcement on Friday, they actually announced they had 86 million subscribers. So they've almost hit the top end of their estimate for what they were planning for in 4 years. So on Friday, what they also did was increase their targets from 60 to 90 million to 230 to 260 million. So they literally tripled their estimates for the direct-to-consumer business. Hulu, they had a 40 to 60 million target by 2024, and they were at 36.6 million. So they've almost hit that. And then ESPN Plus, they were targeting 8 to 12 million, and they're at 10.3. So they've essentially hit that. So effectively, the main and only reason that the stock increased on Friday was because of the direct-to-consumer. So with these kind of growth rates, you'll see down here, I guess one point they had no EPS forecast for 2021. So you can see here, I put the year-end 2020 amounts and then the year-end 2019. Let me zoom in, probably make it easier to see. So you can see the percentage change. So just from a revenue standpoint, media networks actually did well, increased 14%. The parks, which is the main reason for all the losses, decreased 37% revenue year over year, as well as the studios, because people aren't going to movies, they weren't releasing. I think Mulan was pushed back. That was supposed to be a big release this year. Nobody's in the theaters, so studios really had a poor year as well. But the direct-to-consumer increased 81% from in 2019 to this year, and they're forecasting for tripling the amount of subscribers to get to this revenue number. So the future is bright. Effectively, what they're saying, or what people believe, is that Disney is going to rival or potentially even be bigger than Netflix. So if you think about all the growth that Netflix has had, a lot of people are thinking that that's going to be overtaken by Disney. And they'll kind of be the dominant player in the streaming business. So looking at these revenue numbers, so direct-to-consumer, even though it's brand new and it only rolled out, I think it was about 13 months ago that they started it, it already makes up a quarter of all the revenue that Disney has. And with the expectation that subscribers will triple, it's easy to see a scenario in 4 or 5 years where Disney is 50 or more percent generating revenue from online direct-to-consumer streaming. which is very high margin business. So much higher margin than media networks, parks, and studios. So Disney will transition from a legacy media network to a streaming company over the next 5 years. That's kind of the business case for buying it. Well, projects profit, ROE, and debt to capital have all been trending in the wrong direction. Direct consumer growth is expected, so I guess I just say the same thing, which should allow for a lot of cash to be generated, I would expect. Along with things opening back up again, I would assume there's a lot of pent-up demand to go back to the parks all over the world. And then no mergers, acquisitions, or divestitures this year. They acquired 21st Century Fox last year. And then this is kind of re-saying what I said before. So they announced they signed up 86 million subscribers for Disney Plus, which is the top end of their 2024 estimate. And yeah, the sky's the limit. So I put a hold on it for now. If I switch over to the SSG, so at 3.5% is what I put in here. I did cross out 2020 because it does that. But it's almost singularly the effect of COVID. So if we look at that, the trend is a little bit better.
And Matt,
yeah.
What if you put the starting point at annual instead of trend?
I mean, it goes down here, so it's basically negative. So then I'll have to estimate the EPS at growth rates they'll be like astronomical, right? To go from negative to back to normal. Does that make sense?
Yeah.
Yeah. So that's why I put it on the trend. Because I think the expectation is
what about the
return back to normal within 6 months to a year.
What about the debt? The debt seems to be increasing pretty strongly.
Yeah, I mean, it's definitely up. I think they've taken on a little bit to finance some of the acquisition and the spending they're doing on the direct-to-consumer. But given the growth in the revenue in direct-to-consumer, I'm not terribly concerned with a 41% debt to capital. If they didn't have any other growth prospects, that would probably be more of a concern. But there seems to be quite a bit. Okay. So it's a hold at 1.2 to 1 at the 3.5%. I used a 22.5. Which I don't remember why I did that, but I did.
I'm curious, why do you give the earnings 3.5? I'm sorry, maybe you already covered it. I was just looking at
that's the analyst estimate. Well, 3.6 for analysts.
Oh, you used, okay. Why do you give 11% for sales?
Analyst estimate.
Why don't you use a preferred procedure for the EPS?
To be conservative. I could use it.
Or just have earnings follow sales and make it 11.3%.
Sure.
Oh, I think you have to toggle the,
There we go.
the button, yeah.
So if we do that, it comes out of buy at the 22.5, but just barely, right? So it's right on the cusp. After it popped recently.
So watch it then, huh?
Yeah, I mean, to me, it's still a hold. I know we were like
Okay.
talking about selling it because they're a slow growth company, but I think the point here is like they're not. So they have been traditionally, but with this direct to consumer, it's a whole different aspect that hasn't been the case for Disney, and it changed pretty quick over the last like 13 months or so.
Yeah, they're crushing it.
Yeah, I mean, like everybody I know is like, did you see The Mandalorian? I'm like, no, I haven't even seen it yet.
I have a question for Suzanne.
What
Suzanne,
do they mean?
go ahead, Bernard.
Well, just a minute, Jay. That what does it mean, like direct to consumer? What is that? What it seemed like
It's like streaming
all your
on
business goes to
your
consumer.
streaming on your
Streaming. Okay.
yeah. So it's like Netflix, but Disney.
Oh, okay. Another thing here to consider when the revenue, the parks are extremely profitable. When people can go back to the parks, that will help Disney a lot. Yeah.
Absolutely. And I think we have to consider that for next year. They should see some pretty impressive growth given that they were negative 37% sales this year over year.
I have a question for Suzanne. So Suzanne, so for Disney, historically sales is about 6%. When you forecast, do you ever forecast higher than the historical growth?
Than the historic, yes. So if I, for example, knew that Disney had, let's say it was last year, and we knew Disney was going to have the streaming service, then you might take that into account. So you don't want to look backwards. That's not right. You want to look forwards, and you can use lots of different analysts information. You can use Value Line, and you can use Morningstar, and you can use Credit Suisse, and you can use whatever your brokerages tell you, just as information points to justify what you choose. But I will add one thing here when you consider the companies. When you're buying a company, how long do you think that you're going to own this company?
At least 5 years.
So if you
For
think
me.
you're going to own this 5 years, does it matter if the park doesn't open for 6 or 8 more months? If the company can financially withstand it?
Yeah, good
No.
question. Mhm.
Yeah. So my point would be, I think Disney has more than the parks. They have the parks, and they have the cruise line, and they have the Broadway shows, and then they can open up in theaters, and all of those things have synergy, and they cross over. The performers on the cruise ships go perform on Broadway, and then the Broadway performers go perform in the parks. So those things are all shut right now, and the second that those things can open, it's going to be like the Super Bowl. Where are you going to go? I'm going to go to Disney. One of those Disney venues is going to be someplace that all of the families and people are going to go. So if you think you hold it for 3 to 5 years out, well, where do you think it's going to be in 5 years, not 5 months? So you should consider, I do happen to think that it popped on Analyst Day, so probably now is not a time to get in, but my club owns Disney, and we purchased it in the 90s. We purchased it again when it was down, and we'll hold tight because we think that this is a real thing that for 3 to 5 years, yeah, I think I'd like to be in Disney.
Yeah, that's what I'm looking at. Based on what Matt was saying, I was asking myself, should I buy more? And so that's why I was wondering about the number here. And personally, I don't forecast the number higher than historical number. That's why I was just curious, based on your experience, how you do it.
Yeah, I think when you get to the front page of the SSG and you have 3 choices to make, and you can choose anything, or you can choose what analysts are going to say, or the preferred procedure, it's okay to choose any of those as long as when you make that presentation, you can justify why you chose those. There is not a wrong answer as long as you can say why you've chosen that.
Makes sense. Right.
Okay, Matt.
I feel like we should buy more because we have a lot of cash, and it is a well-run company considered that size, mega company, and
I would ask if this is the price point you want to enter in. I think it ran up a little bit, and I don't think personally, I don't think this is the time. I think you can look at Saul's presentations and say there's a great company, it's just not the right price right now. So I wonder if this is not the right month.
Yeah, was it last month, a couple months ago, I think somebody brought this up in my club saying, oh, let's dump Disney. Do you guys remember that? Yes, the price was dropped. Yeah, I know. Yeah, it is kind of. So the 52-week low is at about $79.
Yeah.
Mm-hmm. Wow, doubled. Almost. Over doubled actually. Right.
Okay,
80.
we should move along here because we've got a
Sure.
couple more that we want to review. Mina, did you want to look at the Domino's with the updated ITK file? Is Mina
So
there? I'll
yes,
make
I
you
am. Can you hear me?
I'll make you the presenter.
Oh, it's okay. Actually, it's fine. So, okay. Really the only changes this time around, the reason I haven't circulated a report is that so we discussed, I think, is that the SSG software had mislabeled the Q3 results as Q2 results. So I had prepared that it was Q2 and provided the guidance as a result. So the only thing that's really updated is the guidance from management based on the Q3 results. The numbers in the SS are the same. If you see
Were you able to import the ITK file with the updated? I think the ITK file had the updated numbers in it.
Oh, right, but so the SSG software itself has updated it as well. They corrected.
Oh, they did do it? Okay.
They did, yeah. So if you see here at the bottom there, it's corrected and the values were provided. That add up. Oh, it was. But when I filled this, that's weird. It is looking different now that I'm logging on. I logged on earlier. It had the results there listed and they were corrected. So, and I've just checked with outside sources, and the numbers that we had as Q2 were in fact the Q2 results. So it's still a hold. The only additions are really that the earnings fell short of expectations for Q3. 249 versus 279 that was expected. However, revenues did exceed projections. And so part of the reason that earnings fell were costs, higher pay for due to the pandemic, as well as additional PPE and some of the costs of doing business that way. That was, I believe, that about $11 million what I saw for the increases in cost due to the pandemic. And so the only real negative or the trepidation I saw is that Domino's is reconsidering whether they'll be able to reach their 25,000 store globe by 2025. That was a goal. The reason is just due to delay for the pandemic. It doesn't seem to be any reason like a delay in growth, but and they're doing, and based on the call transcript, that they're doing a heavy investments in AI and autonomous driving to try and cut down on delivery times. And I was surprised to see that their online loyalty program is as invasive as it is. It's like they have over 40 million users and 25 million users who are active. So I was pretty surprised to see that in terms of have an account with Domino's and keep loyalty points and do that sort of thing. So really, I think it's still a hold to me. I think it's a good company at a good price. It still hasn't gone down to target, which I think is about 3-4. It's about 83, I believe, today. So I still think if it dips, there's an opportunity to buy, but at this time, it's still. I don't know if there's it's just strange because I did log in earlier. I had the updated quarterly data, so it
looks like it's 11/16 is the date on there. Maybe you need to update the data.
Oh, this might have been so maybe, you know what, I pulled up and you without completing one, because they just checked. Check this software. Sorry for the delay here.
So I bought a Domino's pizza tonight for dinner.
Just,
I did, and I'm shocked.
What did you get? I meant to email you back.
I just ordered, it was like a half-hour order because they had all these options. I got like a deep dish with onions and spinach and pepperoni, I think. Anyway,
yummy.
I couldn't believe how cheap it was.
Really?
It was like $9 for a 12-inch pizza.
Wow.
Or 14 or
Nice.
something like that. I'm like, that's it? That's all it is? Well, it's a special, but still. Anyway.
That's
Well,
great.
the last 3 quarters look good.
Yeah, so that's why. So the data that's provided in the last SSG that's updated, has this data as Q2. So the last quarterly results, last quarterly report that was prepared is based on actually on the Q3 results. So that's kind of there's a little bit of confusion. That's why I didn't want to send out a new SSG, just not to add a little confusion to it, but I can clean it up a little bit in terms of
Okay.
what's on the
Alright.
drive on the filters. But
Okay.
so yeah, it's still a hold. The data has changed last presentation.
Okay, great. Thanks. Let's see,
Awesome,
who do
thank
we
you.
have next? John, do you want to do Schwab?
Sure, I can do it. I did end up recommending a hold, but I thought you wanted us to do everything, right? So all the
I think Jay wants to take a closer look at Schwab.
okay. All right. There's the SSG. I'm not sure where I should start, whether it should be the PERT or the SSG.
The reason why I want to do Schwab because one of the guests, she's working in financial industry. She asked us to look into banks. So I said, oh yeah, let's take a look, the Schwab. And but I think John also wants to recommend challenge Schwab, I believe.
Well, I did the selling checklist, and the fundamentals look like they're deteriorating a little bit at least. Everything else is a hold. I did go through all these. My bold is where I wrote something down. So it's all, we can go with that later, but it was the selling checklist said it probably should hold it. Or yeah, hold it. So I'll go through this first, I guess. I just kept this the same for my last SSG. Not much has changed in my opinion, so I just kept it the same. These are pulled from the SSG, and it was doing okay a year ago, and it's due to the pandemic, I believe, is my opinion, that it's gone down since then. We'll look at these more closer in the quarterly data. It has seen some price appreciation, as Tom showed us in the past quarter, past 3 months. It used to be I forget what it was at before, maybe 14, maybe 12, maybe 13 for the current PE, and now it's gone up to match the average at 23.6. When I did this report, it's a little bit different now. So that's a 1 relative PE of a 1. And up to downside ratio, I just updated the data, and now it's 0.5 to 1, according to the way I picked it. So compound annual return 2.1%. My notes, a lot of it refers to the merger between TD Ameritrade and Schwab. They ended up acquiring for $21.78 billion, and the fair value of net assets was $11.49 billion, meaning Schwab put $10.26 billion of goodwill on its books. I believe everyone knows what goodwill means in general, but in this case, it means the amount more than the net asset value of the acquisition. So this is put on the books as an asset, and usually, I think, depreciated over time. Maybe not. I'm not sure about that last part. 8.7 billion of the assets are intangible assets labeled client relationships. I'm not sure how that is calculated. I'm kind of skeptical of that being that much, but maybe they can value it that well to be that high. They also acquired the brokerage accounts of USAA. They did not acquire USAA, but they acquired the brokerage accounts. So like the retirement accounts that their employees have, 1.58 billion in cash. And I did also do the net asset value and the goodwill for that. Net interest revenue is one of their main sources of revenue. It was 4.3 billion for January through September of 2020, 4.9 billion January through September 2019, a year ago, and this was due to the low interest rates being lowered by the Fed. So of course, the federal funds rate went to near zero, or I'm not sure exactly where it's at, but it's very, very, very low. And net interest revenue comes from taking money and earning interest on it, and giving interest out to the people who's giving them the money for a lot less, but it's being compressed right now due to the low interest rate with the Fed. They laid off 1,000 employees, but that's just due to the redundancies from the TD Ameritrade acquisition, so that's nothing to be concerned about because they're just creating more efficiency by laying off people that they don't need to have anymore. I'm going to skip the recommendation until we go to the SSG. So there you can see the various numbers declining quarter over quarter since 2019 began. Even quarter one, it was down a little bit. 10-year figures look pretty good. There's my 3 and 3.5. You want me to check the preferred procedure is 4.9. So I don't know if you want me to do that or not, but and debt looks good. And I think I wrote down in my selling checklist what the actual debt is right now this quarter, debt to capital, or at least the debt amount, long-term debt amount. But I guess I would look at this quarterly data. There's trading for quarters. Just looking at the graph and the quarterly. So we looked at this last time we looked at Schwab. I think it was 2 quarters ago. It's been declining. So here it seems to, well, it's just 1 quarter where it's leveled out, but maybe we'll see next quarter if it levels out further or if it starts to pick up somehow. But 0.7 to 0.48 is negative 31.4%, 0.889 and 1.236. So you don't do the math, but it's been decreasing recently compared to the past. So now I'm going to go here, and here you can see. Just show that for a second. Let's people look at it, and then I just chose the average PE, 5-year average. It's pretty close to where it actually is right now. Forecast high stock price. I guess I could have gone higher a little. Maybe split the difference between these two, but that's what I picked there. And then this one I went down to the recent low market price, which when I look back on this, I already gave this to people with this number. I feel like it probably could be a little bit higher than this, but you never know. Where the economy seems like it's in the crapper, but the stock market keeps riding high. So that's that. If anyone wants me to change anything, let me know. But upside down ratio 0.5 to 1, where I changed a little bit from when I did the report. And there's these numbers down here. So I'm going to go back here real quick to my recommendation is a hold. I've seen some price appreciation in recent months. So it was 14.3 in my last SSG, the price to earnings ratio. I mean, the price was lower because the earnings didn't go up that much. And now it's 21.3 right now at the time I wrote this. I guess it's a little bit higher now. So I don't think Schwab is a growth company. It looks to remain not a growth company for a while due to net interest revenue compression. However, it is a high quality company. We invest in high quality growth companies, is what I've heard. And it's a high quality company, I do believe, but it's not a growth company in my opinion. The stock was cheap and the market recognized that and brought it back to a reasonable level. I did the selling checklist, not a sell based on that. So it looks like we'll get a hold now until we see even more price appreciation. So if it gets even more expensive, it may be a good time to sell if it gets unreasonable or the fundamentals deteriorate further. And look here. So this is immediate cash. Obviously, that's not the case. Number 2, sales declined from this to this. Pre-tax profit decline, and we saw this on our SSG. Long-term debt increased from 74.30 on 12/30/19, so over 9 months, to 78.36, which is not gonna break the bank, right? But increasing inventory is not applicable. Increasing receivables, net receivables from brokerage clients increased from 21.67 to 25.41. Operating cash flow decreased from positive 5,021 for 9 months ending 9/30/19 to negative 674.5 for 9 months ending 9/30/20. And you know what? That's a big difference. So operating cash flow can be crazy. It can vary a lot, and probably a part of it was maybe due to the acquisition of TD Ameritrade. But I'm not certain about that. these are all not applicable in my opinion from what I've heard, at least what I read, what I've read and heard. I didn't see any of this happen. Number 3. And then number 4, not overvalued, according to this. What's the value? Upside ratio is below 1 to 1. According to the way I looked at it, it is. Is it less than money market or CD? No. CD money markets have barely any return right now, so it's better than that. I looked at some competitors, Morgan Stanley, Goldman Sachs, and average stock price. I didn't do any math here besides putting up the numbers, but I didn't do any calculations. So they look pretty, the result is no in my opinion. And to diversify your portfolio, it is 5.37%. It is not a big portion. It's less than portfolio, 5%. No, it's at 5% pretty much. And we're 34% mega and large. So that looks to be decent according to this. Not erratic, and I don't know how to do this one. I guess I just ignored that one. So, and
But you basically, your bottom line is that you recommend to hold, and you're saying that it's quality company, but it's not growth company.
yeah, that's my opinion.
Okay.
That's my opinion. At least it's a high quality company for sure. It's got look at these numbers, but it's not
Okay.
I doubt it's going to grow too much.
Suzanne.
The rates rise. Sorry.
Okay. I have a question for Suzanne. So Suzanne, what's your take on financial sector right now, since that they are not performing very well, but interest rate was very low? What's your recommendation for this industry or company like a Schwab or any other regional banks?
I think Schwab is difficult because they have some integration issues coming up with the TD Ameritrade acquisition. And so that's very hard. I know that there's a lot of synergies that they're going to get. I also think that Schwab, like Fidelity, like other companies, is holding the buck on the money market. So their administration on money market funds is like 0.6%, and the interest earned is like 0.2. So they're making up the difference in the interest. So maybe you're getting 0.1% on your money market, but how you're getting that is because they're subsidizing that, because the administrative expenses are more than the interest that you'd receive, so it would be negative. So I think that's dragging on earnings for that kind of thing. But people are in the market, there's no other place to put their money. Of course, they're not getting any trading fees. To be honest, I'd sit on the sidelines on Schwab if I didn't own it. You own it, I'd hang in there and see what happens with the integration. I think banks are looking very cheap right now. I think a lot of them are trading at book value. So you might want to look at a really, really well-run bank that's also paying a dividend and is allowed. I think things like Citigroup are not allowed to buy back their shares right now. And I would take a look at the point that they could, then you might want to be in that space. But it's a difficult industry to value. It's different than any other kind of business. There's so many facets to it that you have to understand. So in general, we don't, in my investment club, we don't hold banks. Personally, I do own some banks, but I'm careful and choosy about which ones I do buy.
Okay. So John, you're going to challenge the company. What are you challenge the company with, a bank or?
No, the company I saw, I was looking at a lot of different companies in the S&P 500, and this one came up a while ago. It was cheaper then, but T. Rowe Price. It's an asset management company. So you can look at their asset management. They're not capital markets like Schwab. They're more of like an advisor. They're different than Schwab. So I mean, the Goldman Sachs.
I thought they're the same.
They're medium size. They've experienced a rebound in their fundamental figures, not just the price. And this has kind of stayed steady, and this has gone back up. I haven't looked further into it. I didn't think I was going to have to, because
no, I know, but you talked to me about it. I was just curious that you want to challenge Schwab or.
This came up for me because it was. I don't know what it is now, honestly. Let me look here. The price to earnings is 17 now, so it's lower. It's experiencing, decent numbers for the.
I think you're on the stock study committee next month. You guys can decide, I suppose.
Well, I'd rather try to. Honestly, I'd rather try to replace Schwab if necessary. if appropriate at the annual report time. I don't know. I mean, if you want to, I don't know if you want to add this and Schwab. I don't know if you want to do that.
Yeah, I'm just a quick comment here. Just going forward, I'm just wondering how Schwab is going to make any money. I mean, like they don't, like the interest rate situation, and no, they don't get any trading fees. I guess maybe they manage some assets, or maybe they have some ETFs or some mutual funds where they get some fees from those, and they're more, I guess assets under management. They may increase their income, but I think it's a good candidate for a sale or replacement. I don't know that we necessarily need to have another financial. If financials, I would tend to look at the, like, I don't know if we like these, but the big banks like JP Morgan, Bank of America, they've got these big investment banking arms that they're able to generate good income even with these zero interest rates.
Here's Schwab's. Speaking to your point, Tom, but yeah, it's a good point, good question, good wondering where they're going to make money from here. Here's their asset management administration fees, which gone up a little bit from. Let's see, I can't see that one over here. I can do that. Yeah, a little bit, but of course the net interest revenue has gone down because of and the trading revenue has gone down obviously because they stopped doing commissions, but it wasn't a big part anyway. It wasn't a huge part at least anyway. Or they already transitioned to doing this part over here, and this part here too. But yeah, if they try to expand this, I guess would be the avenue they could try.
Another thing about Schwab is they have very expensive employees. I mean, I've worked with Schwab for years, and it seems to me that they always have a high caliber person representing the company. That's my impression.
And they tend to stay, I mean, like a lot of these other companies that people tend to turn over. Schwab, it's been my experience that they stay there for a long time.
Yeah.
I wonder if I can ask about goodwill. Seems to be increasing all the time. It's an intangible asset.
Yeah. Where is it increasing besides the TD Ameritrade acquisition and the taking the USA's accounts and managing them?
Yeah. Well, I think as Suzanne was saying, when they start having problems with integration between the two companies, that's when you want to sell, because it only leads to bigger and bigger problems. And then if things settle out, you can buy back later.
Yeah, well, I'm not sure if she was saying that, but it is a good concern either way. Either that it's going to benefit us, benefit Schwab, or hurt Schwab. I guess it could go either way as far as integrating people and integrating a whole other company into your company. Has gone up somewhat. I guess that's a big amount for itself. It's only for itself.
Yeah.
Okay. We have a couple minutes left. I'd like to move on. Is that okay?
Oh, with me.
Okay. I'm going to bring up, Hanny's not here, so I'm bringing up his innovative industrial IIPR. This is our kind of high risk, not a lot of data, historical data. It's a big speculative stock for us. Okay, so this is Hanny's, this is the way the SSG looks. He estimated, and Suzanne, I have a question for you on this. He's putting in very conservative estimates, 20% growth and sales growth, 5.2% earnings, which is, you can see the lines here. It really starts to flatten out, where this is a relatively young company. I don't know if that's what I learned from our previous mentor, is that to be cautious or conservative when evaluating the stock to purchase, but then once you own it, tend to be more on the optimistic side. So let's see. So when he does that evaluation, it becomes a hold. I actually took a stab at it and did a 30% forecast based on analyst estimates, and then did a 14.1% for the preferred procedure. So I guess my question is, when we have a company that's speculative like this, should we be looking at it with a more conservative viewpoint, or is it okay to be more optimistic?
Well, I think you have to say, where can they sustain 30% per year for 5 years? Because that's what you're doing. I mean, if you were like a financial analyst, you would never assign 30% per year for 5 years. You might say next year's 30 and the year after might be 30, but then the following year might be 15 and the year after that might be 10. And this is a more simplistic tool than that. So you have to be able to justify 30% per year for 5 years. And I don't know, it's a real estate investment trust, so they have to return 90% of the right. So I don't actually understand where they would get 30% a year. Usually the real estate investment trust, you buy them for the dividend, buy them for the growth.
Well, this is a kind of an unusual stock, or actually an unusual company, because they purchase warehouses to grow cannabis and lease it back to the company that's growing it. So they're just, as states start opening, and because of federal regulations, you can't transport cannabis or medical marijuana over state lines. So then they're strategically, as states open up, building these warehouses. So right now they have, I think, 62 warehouses, but the market's wide open. And I think they're the only REIT that's doing this right now.
But I guess my question is, then you have to say that, like a REIT's business, they have to give you back their income and over. They don't have a lot of revenue to stick around and grow. So I think you need to analyze this more carefully. I don't know this company, but when you purchase a REIT, you don't purchase it for 30% growth per year. You purchase it for the dividend. So just come up with why it would be 30%. Like I said, I don't know this company, but you need to make the case that says somehow there's something other than the dividend that you're purchasing the stock for, and then make the case for that.
Okay. All right. We're, I think one point was that the management has already, go ahead.
One thing, though, the dividend has been growing. Yeah, this may, I own this, and the dividend is growing. And the MORE Act passed in Congress, and when marijuana becomes legal, and probably in another year or two, medical marijuana for sure, I think this company has room to grow. It keeps growing, and I think it will grow. It's not just a dividend, but there's also growth in the dividend, in my opinion.
Okay. All right. I just want, Hanny has this as a hold anyways, but I just wanted to get some input from Suzanne on when we have a stock like this. So that's a good point of the REIT, is to look more into the dividend. We have been research. The problem with a company that's this young is that there's not a lot of data out there. So, I mean, I don't even think there's a value lines. So we're kind of gone to doing the company research and looking more into the management and their experience. Okay, let's see, what do we have next? Okay, Algonquin and Qualisar holds. Jane, did you want to review cyber, or is that a hold? Is Jane here? Oh,
Sorry, okay, I'm
Jane-
sorry. I was
Jane's
muted.
muted.
Can I hear about Qualys from Christopher? About why Qualys price dropped after the last 2 quarters? Oh, Christopher, maybe just give us a highlight, like any
Christopher's
good,
muted.
any good news or
Yeah,
bad news
I'm
about
here. I'm here.
that quarter.
All right.
I can,
So
let me make
the
her.
highlight. So the reason why they said that. Give me a sec. Let me check it real quick.
Mm.
So they said that billings growth decelerated because the subscription, it's the subscription that's multi-year, it's like on a quarter where they didn't get that much subscription. So they didn't get that much revenue. But however, like I still think that Qualys has good fundamentals because overall, like from last year, they still increased by like 13%. So I still think that they're like growing, and they did better than estimates this quarter. So like I don't think that there's a reason to sell necessarily.
Not so. I'm just curious the reason had a dip on that company. Okay, because of subscription.
Yeah.
Okay, these are okay.
So it did go down from last quarter in terms of sales growth and EPS, but I think that's just like they said that they even acquired like more technology and they're also like partnering. So I'm also not quite sure as to why it dipped in terms of like value.
So they just bought another company?
No, they
Spell?
acquired software though.
Oh,
I mean, yeah, they software assets of Spell Security.
Okay.
Okay.
I'm just curious. Yeah. Okay.
So we're at the section. Oh, Jane, did you want to do a quick comment on cyber?
Yeah, I could.
Is it hold?
It's a whole. And basically, you want to show my screen or I just talk about it? Okay. Cyber.
Maybe just give us the highlight, the quarter.
Basically, cyber has the earning has declined, and however, the earning growth projection we have increased to 6%, and basically we feel that the company is transitioning to a recurring revenue model. So the company will continue to expand its new SaaS and subscription solution packages to its customers. So such transition actually will carry a somehow elevated risk with regard to the disruption of the customer relationship. However, the pipeline continued to increase, and because of demand for the new cloud solutions and such as the privileged access security continue to increase. So we think the earnings EPS growth rate should increase to 6% based on that. Our SSG, as you see on the screen, so it's 6%, and the revenue is increased by 15%. On that basis, the preferred procedure bring us to 6.1% earnings per share. And with that growth rate, our projection of SSG give us a hold because today the price has increased slightly, so now it's about $112, and this is last Friday's price. So it's still a hold at current price level, and I think we purchased at $117 back in July, and I think cyber security has still potential, and because of that, I think Qualys today increased by 7%, and cyber only increased by 2%. So I think we should still hold the company, and the guidance for quarter 4 is about right. I think it's about 130 million for revenue, and the adjusted non-GAAP income will be about 30 million. So with that, I think it's still a company worth of holding. And since we just purchased in July, and we still suffer a slight loss, so we should continue to hold it. And
We lost her.
Okay, her audio. Okay,
Oh.
thank you, Jane. I appreciate it. Let's move on to the, are there any, we're going to discuss, have discussion about buying or selling any of the stocks that have been presented. So are there any motions? I'll take this back.
I just want to clarify that cybersecurity stocks rose today because there was a cybersecurity breach and like the government.
Oh.
So one company went down, but this encouraged like the users to look for other options, which is the reason why other security companies like increase in price. So yeah.
I thought I heard of that. I thought I heard that there was a security breach. Okay, are there any motions to buy or sell?
Based on today's presentation, nothing is in buy, right?
I move.
Disney.
I move. I would move that we buy IIPR, Innovation Productive, whatever. For, yeah.
Okay.
That's what I would motion that.
Jay, do you want to take this? Should I just do that in my iClub?
Wait, you wait for anyone second them.
We
Oh,
don't
you got
have
a second. Somebody's got a second. Somebody's got a second. Okay. Anybody second that?
John, I'll second it.
Okay.
have any
So
discussion?
Discussion.
Yeah, I don't think this is a good time to buy it. The price has just gone bananas. I mean, it just to me this is buying at the top. I know it's performed well, but I don't think this is a good time to buy.
Can we look at the SSG again for the
Joy has.
But the sales and earnings keep going up, going up, going up, going up. The price goes up, but so do the sales and earnings.
Actually, Henny even recommend to. What was Henny's recommendation?
Hold.
Hold.
He wants to sell. He wanted to sell.
He wants to sell.
But I think
actually, Henny, based on his report, he said there's a huge risk about this company. Something to do with what was it, Joanne? Something private. There's some information we were not able to obtain, like.
Well, because the companies that are actually the growers are private companies and you can't get information on them. So he feels that that's uncertain as to the type of business. But I've worked in leasing before, and there's a lot of due diligence that goes on evaluating companies where I was in it was computer leasing, high-end computer systems and solar systems. And there's a lot of due diligence that goes on in evaluating companies before you actually invest in them.
Yeah, and I think we have to think about where this company is going to be in 3 to 5 years.
And the management company was a big team that had I forget what the name of the company was, but they were part of a company that got bought out by Blackstone. It was a real estate type company, and they sold it for $8 billion. So, and then I think Blackstone turned around and sold it for $12 billion. So the management team is really, I think I have a lot of confidence in the management team as far as.
Are we talking about
IIPR. Uh-huh.
Yeah. I just don't see regulations. I mean, the
They're
way
all-
things are going, it seems like it's only going to be positive. I don't see, you know,
Yes.
government
And
putting restrictions on.
Okay.
this is
So,
gonna,
so this is so the part of the
yeah.
risk is that they are focused on like one type of business, and that's cannabis growing. They're not a diversified real estate investment trust like offices would be diversified between, or like medical offices would have different types of medical establishments, and
Well,
that's one issue. And then the other issue is the federal regulations. If the feds start, if it becomes legal federally, I mean, one of the reasons why they do this is because they can't go to banks to borrow money, these growers. So they're kind of the middleman for this, to helping them provide their infrastructure. So that's another risk.
But we would see that coming.
but
And also,
another
yeah,
thing,
that's another thing. Yeah, you would see it coming. Yeah.
and then offices are like probably the worst right now, you know, and I'm talking just with this specific product, just the way it's taking off. I don't know.
Yeah.
And we have all this cash.
yeah.
Yeah.
And the United Nations is considering legalization of marijuana too. Plus Mexico, well, it didn't pass in Mexico yet, but
Yeah.
I think in the next 2 or 3 years, the United States will legalize it, especially medical. It's a very good medicine
Well,
for
is the
pain
marijuana
and
is the
sleeping.
marijuana market really growing? Can't everybody who wants it get it now, whether legally or illegally?
Was that
I
ever
don't
not
think
the
so.
case?
They say there's a 20 to 30%
No,
growth in the industry, just in the dispensary, I guess,
yeah.
industry.
There's still 500,000 people a year get arrested for possession of marijuana. So it's, that's, well, never mind. But I think it's legalization is coming, especially in the medical field. Yes, really. No,
Well, I don't
it
doubt
used to
that,
be
but
like 1 or 2 states.
I'm just wondering if the market is truly growing.
Was that
Yes, it is. I go to a dispensary here in Sacramento, and there's a line of people waiting to get in.
I don't go to the dispensary, but when I drive by the ones in Davis, there's typically a line. And I know
Yeah,
more and more people using it for medical reasons, you know, friends with cancer and
Well, it's legal in California. I mean,
yeah.
for anybody who wants it, as long as you got the money.
yeah. It's just, I guess, how much is it going to grow through the United States? I think they have projections to have that kind of growth. But
Yeah, about
okay.
20%.
I don't. Are we ready to vote?
Are you guys was 1,000 IIP or two? How much?
Oh yeah,
How much of
Bernard,
IIP?
how much?
Well, 2,000 or well, 1,000 because you guys are always very conservative. Whatever we
We
can
have a
do.
money, so but not whatever you prefer.
No, I
Joanne, I'm actually
think it's
typing
a
it
good
up. I'm sending.
investment.
Oh, are you
I'd
doing
bought
it,
some
Jay?
myself.
Thank you.
Yes.
Okay.
Okay. 2,000. We do have a money. We do have a lot
Yes.
of cash. Okay. Okay. All right. So now I6. Okay.
that would make it our
targeted this.
largest investment, just to be clear.
Yeah. Okay.
Say that again.
So
It would be our largest single holding.
What are we at right now?
Total worth is 47.83. So if we bought 2,000, 67.83.
oh, okay. Glad you checked.
But it's
that.
only But it's like 6.3% of the portfolio, right?
Yeah, and
And-
it's one of our only small companies.
Cash is the
Oh,
biggest holder.
okay. Okay.
Yeah, I just let you know.
Thanks.
Yeah. Okay. So the motion
It's
is emailed to you. You can log on to my iClub to vote as well. Motion 49 by Bernard, second by John Caddison, buying 2,000 of IIPR.
Okay.
I see two motions.
What did you say, John?
I see two motions, motion 48 and motion 49.
Oh, oh, I was going to modify it. Okay, oops, I don't know why there are two. I'm going to delete the 48.
Yeah.
Okay.
Okay.
How do I know which one I voted? I voted once already.
Okay.
I'll
Yeah,
see
actually, you guys
if you
are good.
voted. You
Okay.
voted.
Okay. All right. Thank you.
Tom Jones hasn't voted. Jane hasn't voted.
What about
Bernard.
me?
But it shows me, it shows I voted on 48.
Oh, I'm so
No,
sorry
she deleted
because I
48.
got, yeah,
Deleted
current is a 48.
Current 48, I voted on the 49.
I'm so sorry, guys. I don't know why there are two motions. Maybe I was
Okay,
modifying the prompt.
we're voting on 49. Vote
Okay.
on 49.
Well, it's if I look at current motions, it's not showing. Well, I can.
Yeah, 48 is the only one left.
Oh,
We can't, yeah, but we can just look at the, so never mind, it's already passed, the motion passed. 8 yes, 2 no, 1 abstain.
okay.
Motion passed.
Okay.
Okay.
All right.
I vote yes.
Annie's
I
gonna
don't know
be
my password
mad.
anymore, frankly.
Yeah, Henny's going to be mad.
That's what you get for not showing up.
That'll show him to be absent. That's right.
That's right.
Yes, yes. Hey, Joanne, do you think we have a time to have Suzanne to go over one of the stock for his for her club? That
Yeah.
You know what?
Well,
You know what? I think
Let's
we
post-
should do it next time.
okay.
Yeah.
Okay.
Okay.
Right.
I'll quickly go over the business items. We have new officer nominations coming up. Our next cycle starts June 2021. And I don't know, Jay, did you want to say anything quickly?
Yes.
About
So I submitted to nomination to the nomination committee, which Jane, are you on the committee, the nomination committee? Because Roy was on it, but but anyway, I sent it to Tom right now. I believe Tom and Jane supposed to be on nomination committee. I nominated Mina to be the president, John Callison to be the VP. So
and who's Hanny would be secretary,
yes.
and Tom Jones or Tom Loftus treasurer.
So I was
Oh.
asking Tom, so we ask people having 2 years to be the max to 2 years. I don't know if Tom Loftus willing to be the co-chair. If Tom Jones retire from this position, we're looking for somebody young, somebody. That's what Tom Jones was. No, Tom Loftus was saying somebody.
Well, that's not us.
Tom Loftus was saying something young or younger or newer to be fill the position, and he's waiting to be the co-chair.
For treasurer.
For treasurer. Megumi, do you want to do the treasurer? I want to tell you, you don't have to do the same thing as what Tom Jones did. Actually, yeah, each treasurer
We
will
can
do
talk
things differently.
offline.
Yes,
Yeah, talk
absolutely.
offline.
Okay.
Okay.
So I just want to quickly, since we only have like 6 more minutes left, I just want to also go over. Hanny had asked us to declare if we own a stock or not, because I think Tom Jones, you said nobody owns Franco-Nevada. But anyway, so what we have is we have our club portfolio. It's here. This is where you'll go to add your, if you own the stock, Oh, actually, I have it open right here. If you own the stock, say I own Qualys, and there's already a 2 there, I'd put 3 that I also own Qualys. So that's all you have to do is if you own a stock, put it in there. Just add +1 to whatever exists.
No,
That makes sense?
I made this suggestion in an email, but is there a place on the, can you create a box where we can maybe sign our name to verify that we have put our stocks in there? That way we know who has completed the job.
Mm-hmm. Sure,
Like,
I did.
okay,
Join did.
okay,
Okay, good.
Tom, did you do
okay.
it?
Well, I added mine, but I didn't know where to put my name. You know, we don't know
We'll
who's.
put it down at the
No. I
bottom
think,
here.
did you indicate the these companies?
I put in my holdings. I
Okay,
added
okay. Oh, you
I
did.
added
Okay,
mine already.
okay, gotcha. Oh, I
And
see.
and there's also some down here that we don't
Put
even
in,
hold anymore.
Right. I put that
but we
anyway.
still hold, but we still
I did
have
not
them.
sell
I mean,
Skyworks. I still have Skyworks. I still have a Heckle. I still have IPGP, CSIQ, Biogen, PET. I have all these companies. I still have. Believe it or not, I still have CVS too.
okay.
I'm waiting. I set a price on CVS.
Yeah,
But
Is there,
we're not monitoring
okay.
them. We're not doing
No,
I
we're
still,
Not. We're
well,
not. I'm
that's
just.
another discussion. I feel like we need to monitor some of the sold stocks or the sold stocks to see if we made the right decision. But that's another discussion down the road, Tom. Okay, quickly. So here's stock owners column. I want everybody to go in and add a number and then put their name at the bottom once they enter it. Then also, this is a part of a larger discussion is that we want more member participation in the club. So part of not only following a stock is to be a peer reviewer. So for instance, I'm a peer reviewer for IIPR and Jay is a peer reviewer for Qualys. So that means when the stock follower presents their stock a week before the quarterly report or annual report, we would go in and do a peer review. So what I would ask everybody to do is to go in and put their name down for a stock that they would like to be a peer reviewer for. And then once we rotate the stocks, that stock, you would become the follower of that stock. So
Yeah, because we feel like it's too many stocks that we can review all of them, right? I have to
yes,
admit, I miss a lot of them. And we thought, okay, let's just dive deep, have at least each person review one company and to be the peer reviewer.
Can you review a company that you did the study on, or is there like a
yes,
rule?
yeah,
Yes,
yeah,
you can review a company to study on.
yeah.
You don't follow
Okay.
the company that you study, but yes, you can do the review.
Okay, and then I also noticed that Piero does not have a stock and that Matt has
Oh.
2.
Oh, okay.
Maybe Piero, I know Piero did the initial Inogen.
Yeah.
Do you want to be the follower for that one or Disney? Piero?
For Inogen or Disney?
Yeah.
I'd rather do Inogen because I have a little bit of a background in it already.
Okay. Okay, Matt, is that okay?
Yep.
Did Matt leave? Okay. All right, Piero. So Piero, you're the follower for Inogen. Okay. Anything else? So that's.
I can peer review for Facebook.
Which one, Jane?
Facebook.
Oh, Facebook. Yes, she's very
wants
good
to
with
be the
Facebook.
peer.
I know she actually was the follower for Facebook. She has a lot of knowledge about Facebook.
Yay.
Okay. All right. Okie doke. I guess that's it.
Can I
Go
do
ahead.
back
I get some
on
fill.
Inogen?
Yes, Megumi.
Megumi
Megumi
wants to
wants to do the follow Inogen.
I gotta go, but
Anybody else?
7:30. But I'll talk to Jane over email regarding
Oh yeah, next month
next
stock
month.
studies.
Yeah. So
Oh
I don't
yeah,
know if we're gonna talk about
let's
that,
see.
but I gotta go actually.
Oh yeah.
Okay,
Next
John,
month's
Jen, and
stock
I have
study is Jane, John, Adam, and Reddy. And then I also offer my, I guess, stock study management,
facilitator.
whatever, consultation if you want me to organize the meetings and kind of the overview of all the tools and resources available. So let me know if you want to just include me in your invite, or just ask me to organize the meetings, and I can do that.
Okay.
Okay.
Thanks.
Is there anything else?
Yeah, I'm sending out an email now with the link. So if you have not
Okay.
already done so, please put the current SSG for the stock you are
Oh
following
yeah.
Okay.
into the folder that
Okay.
that the link leads to.
Okay.
Thank you, Tom. Okay,
You're
so
welcome.
I'm going to adjourn this meeting, and then we will go to our guests unless anybody has anything else to say. Okay, go ahead. Anybody? Okay.
Have a good
meeting is
holiday.
okay. Everybody have a good holiday. You're right.
I'll
We
see you
won't
in
see
January.
next year.
Yes.
2021. It's going to be a
See you
better
next
year.
year.
Hey.
Okay. All right. Bye.
Bye.